$1.28 trillion. That is how much Americans now owe on their credit cards. The Federal Reserve Bank of New York just released its latest household debt report, and the number is the highest ever recorded. Not adjusted for inflation. Not projected. Actual debt, sitting on actual statements, accruing actual interest, right now. And the average interest rate on that debt? 22.3%. Which means if you're carrying the average balance of $6,300 and making minimum payments, you will be paying that off for the next 18 years. You will pay more than $9,000 in interest alone. On a balance that started at $6,300. That is the math they don't put on the welcome offer. 47% of American cardholders carry a balance month to month, up from 39% just 4 years ago. And 12.7% of all credit card debt is now 90 or more days past due. That is not people forgetting to pay. That is people who cannot pay. But here's where it gets worse. The one agency that was supposed to protect you from this system just had its teeth pulled. The Consumer Financial Protection Bureau had finalized a rule to cap credit card late fees at $8, down from the current average of $32. That single change would have saved American families more than $10 billion a year. It was killed. A federal court vacated the rule in April, and the agency itself agreed to let it die. The same agency created after the 2008 financial crisis specifically to prevent banks from doing exactly what they are doing right now. So the cap is gone, the fees stay at $32, and banks keep collecting roughly $14 billion a year in late fees alone. Here's what they don't tell you about credit card debt. It is not an accident. It is a business model. Credit card companies do not make their real money from people who pay their bills on time. They make it from the ones who can't. The interest, the late fees, the over-limit charges, the penalty rate increases. Every single one of those features is designed to make it harder to escape once you fall behind. In 1980, the average credit card interest rate was 17% and there were federal usury laws limiting what banks could charge. Then came the Supreme Court's Marquette decision and the deregulation wave of the 80s and 90s. Interest rate caps disappeared. Banks moved their credit card operations to states with no usury limits. Delaware, South Dakota. And the rates climbed. Today, some store cards charge rates above 30%. That is not lending. That is extraction. The pattern repeats. Before the 2008 crash, household debt hit record levels. Banks were handing out credit to anyone with a pulse, collecting fees and interest while the good times lasted, then getting bailed out when the music stopped. Total household debt is now $18.8 trillion. That is higher than it was before the financial crisis. And this time, the safety net is thinner. The agency meant to watch the banks has been hollowed out. Interest rates remain elevated because the Federal Reserve cannot cut fast enough without reigniting inflation. And the people on the bottom, the young borrowers, the low-income workers, they are the ones defaulting first. This is what economists call a K-shaped economy. The top half is fine. The bottom half is drowning. And credit cards are the anchor tied to their ankles. So here is the question nobody in power wants to answer. If 46% of cardholders are carrying balances not because they're irresponsible but because groceries and rent and gas cost more than their paychecks cover, who exactly is this system designed to help? Because it is clearly not them. $1.28 trillion. That number is going up. And until something fundamental changes about how this country treats consumer debt, it is not coming back down.